And we are live. Hey, everybody, Smart Silver Stacker here. Hope you're doing well this evening. We've got a lot to talk about today. I want to discuss what we saw happen in the markets today because the narrative seems to be that, the soft landing's here, right? Everything's fine. We saw the 10-year yield pull back a little bit. There's been talk of the debt sell-off that we've witnessed over the past several trading sessions coming to an end, but I want to tell you why there is more pain on the way. This is not done yet, not by a long shot. I'm going to show you some numbers which I think will confirm that for you. First, I just want to say a big thank you to everybody tuned in. We're going to talk about the precious metals markets as well and what they did today. I mean, really, stocks were up today. We saw commodities come under some renewed pressure. Crude oil was selling off in a pretty big way. It was down about 5%. Gold and silver. Gold was down. Silver hanging pretty tough. I think it was slightly in the red today, but kind of recovered off of the lows. It amazes me that gold and silver remain on sale in light of everything that is happening in this economy. It is pretty crazy. But I think investors are kind of buying the narrative that this pullback that we've seen in the 10-year yield, the debt sell-off, pausing for a moment here is a good sign. But, when the 10-year yield drops 1.3%, but you look at the chart of where it has gone so far this year, I mean, this is a relatively small move, considering the fact that the rate has spiked up so much in recent trading sessions. I think this is just a breather. The debt market had gotten a little oversold. Now, we talked about this in yesterday's live stream or last night's, but if you want to know why the interest rates on the US Treasuries are going to continue moving up, or the yields on the US Treasuries are going to continue moving up, I've got one word for you, and that is supply. That is because the supply of bonds being put out onto the market right now is enormous. You've got foreign holders selling them, you've got the Federal Reserve with their quantitative tightening selling them. But more importantly, I mean, this is the move we discussed in last night's live stream. The US national debt moved up over a weekend from September 29th to October 2nd by about $275 billion. You can see this is the number for September 29th right here. That's the number for October 2nd. So when you can rack up about, it comes out to about $4 billion an hour of debt, that's all treasuries, that's all debt that has to be sold out onto the market. So when you flood anything, you flood the supply for corn or wheat or shares of a stock or silver or gold, when you flood the market with these instruments, there's going to be a sell-off. And remember, when the debt is moving down or the value of the bonds is moving down, that's when you see yields rising. And I kind of do want to talk a little bit more about the bond market and how that works in just a moment. First, a big thank you to today's video sponsor, sdbullion.com. Right now, they've got this great sale over there, $50 for $329 over spot. I mean, I do think this is an incredible sale. Right now, new customers can also get gold or silver at spot by visiting sdbullion.com/news. So check them out. There's a link down in the description. See some folks in the chat saying hello there. Finally made a live. Well, welcome Creek Runner 207. Glad to have you, sir. Or ma'am, whoever you happen to be. Kind of a androgynous username. No offense or anything, but welcome to the stream. All right, so we have got banks coming under a huge amount of pressure here in this country. Why is that? Well, it's because the yield on these treasuries is moving up, and that means the underlying bonds, which these banks have quite a bit of, are falling in value. They've got all these unrealized losses. I want to take a look at this. This is a report from the FDIC itself. This is a press release from September 7th. If you want to look it up, there's the title. But this was published on September 7th, and there's one paragraph in particular that I want to draw your attention to this evening. It's this one right here. Unrealized losses on securities. Now, this is regarding the banks in the US. This is the FDIC. They're publishing this. Unrealized losses on securities increased quarter over quarter. So this is for Q2. Unrealized losses on securities totaled $558.4 billion in the second quarter, up 42.9 billion. That's 8.3% from the prior quarter. Unrealized losses on held to maturity securities totaled 309.6 billion in the second quarter, while unrealized losses on available for sale securities totaled 248.9 billion. And those securities, those are US Treasury securities that the banks are sitting on. Now, this means that in Q2, the banks have unrealized losses. So that means that it's just on their balance sheet. They haven't actually sold these bonds. But if they're forced to, because of, say, depositors withdrawing their funds and they need to raise liquidity, they will be forced to take these losses. And that's exactly what happened back in March. Now, the reason this is so telling, I think, is because this is for the second quarter numbers, mind you. $558.4 billion in the second quarter. Now, before we move on to looking at what the losses might look like today, I do want to examine this page from Fidelity because this is important to understand how bonds and interest rates work. So this is a page on Fidelity's site, Duration, Understanding the Relationship Between Bond Prices and Interest Rates. Okay, so this is very, very important. This is a good article if you want to read this to kind of get an idea of how the interest rates are related to the underlying value of the bonds. But this chart pretty much explains it. You see the yellow mark there. This is for every increase 1% in the interest rate, this is how much they lose. So a 6-month bond only loses a small fraction of its value if the rate increases by 1%. But you can see a 10-year bond loses almost 9% of its value every time the yield goes up by 1%. And then for 2%, it loses about 18%. If it goes up 3%, it loses, more than a quarter of its value. You get the idea. And this is because, well, let me just read this paragraph to you. The chart below shows how a bond with a 5% annual coupon that matures in 10 years, that's the green bar, would have a longer duration and would fall more in price as interest rates rise than a bond with a 5% coupon that matures in 6 months. Why is this so? Because bonds with shorter maturities return investors' principal more quickly than long-term bonds do. Therefore, they carry less long-term risk because the principal is returned and can be reinvested earlier. So the point is here, say you have a 6-month bond, the rate goes up on it, doesn't really matter because you can just hold that to maturity. It's only 6 months and then you get the face value back plus whatever the coupon was. But a 10-year bond, let's say you buy a 10-year bond and it's yielding 1%. Well, now the rate goes up to 2 or 3%. Well, if you want to go and sell that bond back into the market, you don't have 10 years to wait to get the face value back to let the bond go to maturity. You have to sell that bond at a discount because right now, your bond is yielding 1%, but the new ones are yielding 2 or 3%. So in order to compensate for that lower yield on your bond, you have to sell it at a discount. I hope this makes sense. The point is that let's look at the 10-year yield here, the year-to-date chart, because this is going to give us some insight into how bad these losses for the banks are getting. So this is the year-to-date chart. And remember, that was Q2, where we had about over $500 billion of unrealized losses of these bond portfolios. Well, going back to the beginning of Q2, so that would be April, and these Yahoo charts are a little finicky, but you can see the rate on the 10-year was about 3.49. Okay, now go to the end of Q2, which would be, what month would that be? July, the end of July. Or I'm sorry, the end of June would be the end of Q2. So you see the rate was just nominally higher, 3.94%. Okay, so, the rate moved up that much and they lost 5.4 billion or $545 billion, whatever that figure was, over $500 billion worth of losses. Well, look at what in Q3 the rate did. I mean, it's moved up considerably more than that. We just finished up at 4.73%. And again, it was under 4 at the beginning of Q3. So, the losses for Q3, unrealized losses, are even bigger, almost certainly, than that $500 billion worth of losses that the banks experienced in Q1. And with the supply of bonds that are being sold onto the market right now, like I showed you there, $275 billion worth of debt issued by the Treasury over a weekend. That is going to continue to drive yields much, much higher. And the thing that investors, I think, are getting wrong here, so let's talk about what happened today. What triggered the pullback, ostensibly, in the 10-year yield and why the stock market rallied today, why the debt sell-off came to a pause. Well, it was because these ADP jobs numbers came out, okay, and they came out weaker than expected. There were about 89,000 jobs added according to ADP. Estimates were around 150,000. So what signal does this tell investors? Well, investors look at this and they think, oh, so the jobs numbers were weaker than we expected. That must mean the economy's cooling. This is going to give the Fed the ability to pause their rate hike, something which we already saw at the last FOMC meeting. And so they think, well, rates aren't going to go higher now. But the thing is that, well, for one thing, we've got more jobs numbers coming out on Friday. We're going to get the government non-farm payroll numbers. So, that could have a significant impact. And, the trend for the non-farm payroll numbers is that they've consistently come out much higher than the reality. They get revised down lower. So, is this month going to be higher than expected non-farm payroll number? Who knows? If it is, then the sell-off in debt will probably continue. I'd be curious to know, folks out there watching, which do you trust more? The ADP numbers, which, I mean, I don't know how crooked ADP is as an organization. I have no idea really, but I will say that I tend to trust their numbers a little bit more than the government numbers that are coming out on Friday. Give me a 1 in the chat if you think that the ADP numbers are more reliable as to what's going on in this economy. Give me a 2 if you think that the government non-farm payroll numbers are more reliable. I would be interested to know what you think. Also, I'm going to pause real quick. We've got 190 folks in the live stream right now, 56 thumbs up. I want to say a big thank you to everybody who's tuning in, everybody who has smashed that like button. Let's see if we can get it to 100. I would really appreciate it. Help spread this information. And I think this is something that people need to know about because the mainstream media, they take any, ray of hope, like a little bit of a pause in this massive debt sell-off that we've been seeing. I mean, again, look at the year-to-date chart. Does that look like something to be hopeful about? If, the higher this rate goes, the more bonds are selling off. Look at the pullback we've had. Not much of a pullback. And considering the rate at which things have been selling off, I think it is, we were just due for a pause, a breather here, a little bit of recovery in stocks. Although, one thing we didn't see was gold and silver didn't really recover much. Gold came under some renewed pressure. Silver more or less flat on the day, a little bit in the red earlier, and then kind of gained back those losses. But investors are seeing this and thinking, oh, cooling job numbers, and this pain in the economy. I'm scared about growth. I'm scared about deflationary pressures, that sort of thing. What they don't realize is that this crisis that is brewing in the banking sector and which is going to continue getting much worse ultimately, and it's not, again, not just the banking sector. That's what I focus on because I think that's probably going to be where we see the next shoe fall in this crisis. But there's a debt crisis across the board. You've got credit card debt at a super high rate, credit card delinquencies soaring. It's over $1 trillion in credit card debt. You've got student loans over $1.5 trillion. And by the way, consumers who are already tapped out, probably going to start having more and more delinquencies in those credit cards. They're going to have to start paying back student loans to the extent that they have any student debt. So that's going to make delinquencies for other types of debt even worse. You also have the U.S. government. I mean, $33.4 trillion. It was like 2 weeks ago that we were under 33 trillion. This magnitude of borrowing is absolutely incredible. I was actually watching one of my videos for reference. I was trying to see, what the video is about, and I was watching this from 2 weeks ago, and I had the debt clock on there, and it was 32.9 trillion. Now we're at 33.4. Think about that. That is in less than a month, like $500 billion of debt. This is, shocking numbers here. And the debt sell-off, if we keep printing or we keep selling these treasuries onto the market, the money printing will come later when all of this debt has to be monetized, because that's ultimately what's going to happen. And that's what investors are ignoring here. They're just thinking, oh, economic slowdown, gold and silver will fall. They don't realize that what we are heading for is a massive debt crisis, a massive systemic debt crisis, a sovereign debt crisis, and a currency crisis here in the US. Because when this debt crisis manifests itself, the only way to resolve a debt crisis of this magnitude is to bring interest rates back down. Well, how do you do that? Well, somebody has to come in and buy the bonds to drive the price of the bonds up and drive the interest rates down. So it's not going to be China. It's not going to be Japan. I don't think that the American people are going to be capable of buying trillions of dollars of debt, especially at a lower interest rate. So, who's going to do it? Well, I'll give you a clue. It starts with F and ends in Federal Reserve. That is who is going to have to buy all of this debt. And that is going to mean inflation in the future will be much, much higher. It's the only solution to this debt crisis. At this point, I don't even think austerity, tax hikes, any of that stuff could resolve this problem. The banks are going to fail, or there's going to be some kind of a debt crisis. Something is going to break, and a lot of people have been calling for this for a while. They see that in a system as leveraged as we are, you cannot raise interest rates. And the stated purpose of raising interest rates by the Fed is to fight inflation, but Jerome Powell is not a complete moron. He's got to understand that when the federal government is spending $250 billion over the weekend of deficit spending, a quarter basis, a 25 basis point rate hike or a 50 basis point rate hike is not going to be enough to counteract the inflationary pressure of that kind of deficit spending. So, it kind of makes you wonder, are they intentionally trying to crash things? Is that the name of the game? Implode the system so that they can come in with their solution. The printing press, of course, being their primary tool to achieve that end, being the buyer and lender of last resort. But again, that's kind of just neither here nor there. I'd be interested to know what you think. Do you think that this is intentional, that they are trying to implode the system to transfer massive amounts of wealth to their cronies, or do you think that they just don't know what's going on? Put a 1 in the chat if you think it's intentional. Put a 2 if you think it is incompetence, because it's got to be one or the other, right? Because the economic outcomes that we're witnessing are nothing short of disastrous. But it's hard to say. Okay, people seem to think it is. We've got some mixed responses there. I'm seeing more 1s than 2s, but yeah, I mean, I'm starting to come along to that view as well, that perhaps this is an intentional collapse. It's engineered in order to transfer wealth. That's what they do. I forget which one of the founding fathers said it, but said, first by inflation and then by deflation, they'll rob you of the land that your forefathers conquered. I'm paraphrasing there. I think it was Thomas Jefferson. But anyway, yeah, this crisis, the pain is not going to end. That's really the thing I want to emphasize here, too. Confirm that, even though many of the mainstream media are kind of saying everything's fine now, everything is, the stock sell off is over, the bond sell off is over. We've got this headline from Bloomberg today. Wells Fargo gets pickier on regional banks with 4 downgrades. And I just want to read a little bit of this to you to show that, despite the fact that we're hearing everything's fine, the soft landing is coming in, the analysts at some of these banks are recognizing that there are some serious problems here. So downgraded was Bank of California Inc. and First Horizon Corp. On idiosyncratic issues, is what they called it, saying that the former's deal with PacWest Bancorp will be positive in the long run, but it will take time for that to be reflected in the stock. And then with First Horizon, they cut the stock is down 57% this year after its planned deal with TD Bank fell through. And then they also downgraded Associated Bank Corp and First Interstate Bank System Inc. on macro pressures. So, yeah, a lot of these banks are going to be coming under macro pressures as interest rates continue to soar. Like we said, according to the FDIC, 545, right? Is that the number? It's more than $500 billion worth of losses in Q2. Very likely those losses are much worse now after this debt sell-off. And we just hit 100 likes, so huge thank you to all of you. I really appreciate the support, helping to spread this information and get the warning out that everything's not okay, folks. And, gold and silver right now are on sale. I plan to continue purchasing them. I've had a few people in the comments recently leave me messages that said they liquidated their physical holdings because they are just disgusted with the metals after this drop. And listen, I don't sit in judgment of anybody who watches this. I don't know your personal situation. Everybody's financial situation is different, but if you weren't selling your gold and your silver at, or your silver, let's say at 25 bucks, a couple months ago or a couple weeks ago, why would you sell it today? The individual who left this comment said they were going to take all their money and put it into a savings account yielding 5% and collect that. And to me, they even mentioned that they were going to take losses on some of those things. So it's like, you're going to take losses on your silver, put it in an account, earn 5%. Who knows how long it will take you to recoup those losses, earning 5%. It's just, again, no judgment here, but that seems like the epitome of, a weak hand. It's like the buy high, sell low mentality. Listen, when you see an asset like silver, which I mean, to me, clearly is undervalued, even when you see it falling, it does take some guts to go in there and buy it because who knows? I mean, it could fall further, but you're probably not going to time these markets. That's something you need to be aware of. You're not going to pick the absolute bottom. To me, the fundamentals indicate that inflation ultimately is going to be the end game here when this crisis really breaks. So I think it is likely that gold and silver could fall further given the fact that we're on the brink of this crisis. But when the crisis really breaks out, one, I've said this before, but I do believe that only paper gold and silver are going to be what's selling off. ETFs, futures contracts, that sort of thing. It's not going to be so much the physical, although the individual who left that comment did sell their physical. So, look, silver is not for everybody. It is, you might even say it's a little bit riskier than gold. Like if you just want a pure safe haven play, I think gold is probably the place to go. And again, none of this is financial advice. I'm just telling you my thoughts. Silver is a lot more volatile. It's a much smaller market, but to me, the potential for gains, the risk reward with silver is more favorable because even though when the metals sell off, silver does tend to sell off faster. When they get moving to the upside, it tends to move faster as well. And I view silver as an incredibly undervalued, very important strategic resource. I mean, you need this stuff to make cruise missiles. You need this stuff to make medical equipment. You need this stuff to make drugs. You need this stuff to make clean water. You need this stuff to make electric vehicles and solar panels. All that stuff requires silver. The world has a diminishing supply of silver. Last year, according to the Silver Institute, more than $200 billion deficit. That's the consumption compared to production versus and recycling. So, we're not pulling it out of the ground fast enough to replenish what is above ground. Are there above ground supplies of silver? Yes. A lot of them are in the hands of stackers. And I don't know about you, but in order for me to sell my silver onto the market to make it available for all those folks who need it, the prices would need to be a lot higher than they are today. That's just my thought on it. I got somebody in the chat asking, is silver an inflation hedge? Well, in the very long term, yeah, it is, I think. It's not like a perfect inflation hedge. It doesn't go up when inflation goes up, but over the long term, the metals do preserve purchasing power. It's not really even up for debate if you ask me, because, there have been how many hyperinflations over the past 2,000 years, let's say. There have been a lot. I mean, there have been a lot of hyperinflations, fiat currency destruction over even the past, say, 100 years. I mean, you got the Weimar hyperinflation, you got Venezuela, you got Hungary had a massive hyperinflation following World War II. A lot of countries had hyperinflations following World War II because war is a massively inflationary event. Countries borrow huge amounts of money that has to be monetized to pay for war. So the point is, anybody who is holding gold or silver through any of those hyperinflations, they preserve their purchasing power. So in that sense, yeah, gold and silver are inflation hedges. What is the 1980 inflation adjusted silver price? Someone asks. If you use the CPI, so silver hit just under 50 bucks, I think. I think it actually did hit $50 in intraday trading in 1980, but if you adjust that number using the CPI, you get a number of about 200 bucks, I think just over. So that's the inflation adjusted all-time high for silver, $200. Today it's about 21 and change. So to hit that inflation adjusted all-time high, you would need to see a 10x increase. Is that potential available with silver? Yeah, I think so. Is there risk? Yes, there's risk with anything. There's, I think, more risk with holding fiat paper earning 5% than holding metal. I think there's more risk in that, but literally everything has risk. If you take your fiat currency out of the banks because you're worried about the banks, the currency gets devalued, right? You leave it in the banks, you get bailed in. You have digital assets, they're vulnerable to cyber attack. I mean, there's all sorts of risks, right? Sure, the FDIC is out there, but look, the FDIC, when you look at the losses at these banks, like the 500 plus billion dollars that they lost in quarter two, unrealized, of course, until they actually need to give depositors their funds back. When you look at those losses, you have to understand the FDIC doesn't have the funds to make these banks whole. The FDIC collects like dues, like premiums from banks over time. They do have some money, but they don't have anything near the level of deposits in these banks that are going to need to be bailed out. And so even if you say, well, there's no risk in having my money in a bank account, assuming you have under the insured limit of $250,000, the risk there is inflation because if the banks fail, and they have to print the money to recapitalize the banks and to provide depositors with their money. Yeah, you're going to get your money, but it will have lost all of its purchasing power, right? So even that there is risk in, and there's risk everywhere. And to me, the fact that markets are discounting the safe haven status of gold and silver at this point, I think it just shows that folks haven't quite gotten the memo about how much leverage there is and how much risk there is in this economy and in this banking sector. I think that it is just people are buying the mainstream narrative, and we know that this is all about perception management. Every time the Fed comes out, they want to tell everybody that they are going to get inflation under control and everything is fine with the economy. It's the strongest economy we've ever had, right? Bidenomics is going to save us. Get out the whiteboard and do some doodles on there to show us why Bidenomics is going to fix everything. Well, I mean that's a bunch of nonsense. There is no central planning policy that can resolve the kind of debt bubble that we have gotten ourselves into. And that's what you get when you keep interest rates near zero for, a decade plus. People borrow a lot. Oh, shocking, right? I mean, it's like, Jerome Powell telling us, now we understand how little we know about inflation. No, this stuff is not hard to understand. I am not an economist, but I can understand that when you have $33.4 trillion in debt and rising at an exponential rate at the same time that you've got high inflation and the deficits are ballooning, that that's probably going to entail some inflation in the future. This is not rocket science. If you have debts that are only payable with devalued currency, well, guess what? You're either going to default or you're going to pay in devalued currency, and that is the route that we're going on. Sure, they could just let everything fall apart, but I just don't think there's anything that the Fed has done in the past to indicate that that's what they're going to be. But yeah, we got banks getting downgraded. We've got the 10-year yield looking like it's taken a little bit of a breather, but I would not be surprised if maybe on Friday we see the debt sell-off resume, depending on those non-farm payroll numbers. But look, I mean, those are all cooked numbers anyway. The fact that they actually drive market activity, I think, just shows you how rigged this system is. I mean, it's all driven by high-frequency algorithmic trading. They look at these headlines, they look at these numbers as if they're real, and Mutant Bamhammer says, reminder that it's not a good video unless Smart Silver Stacker blinds us with silver. Yeah, sorry, is the reflection too much here? I'll try to hold this up. But this is Kawatamok Senior, the 5-ouncer. Last night I had the 1-ounce coin, but this is the big one, the 5-ounce Kawatamok Aztec calendar round. I think that this is the appropriate silver to show at a time like this because this sort of has some apocalyptic connotations when you look at it, I feel like. And that's what we're on the verge of here, folks. Don't buy the mainstream narrative that everything is fine when it's hidden right in your face that everything is not. Anybody who sees debt numbers like that should understand that inflation is on its way. Now, how long is it going to take to get here? I'm not sure. One last thing I do want to look at is this chart of the federal funds rate. So when people see this ADP number that came out today with weak job numbers, one of the things that kind of triggered the rally in stocks and the decline in the yield on U.S. Treasuries was that folks are thinking, well, the Fed now can pause its rate hikes. And again, we already saw this at the last FOMC meeting. Cult Leader says, put that paper back. I want to screenshot it. Just Google U.S. Treasury debt to the penny, and that will bring up the site that has that debt information on it. But look at this chart. This is the federal funds rate, okay? And we looked at this the other day, but I think it bears revisiting. Look at what the Fed did with the federal funds rate in 2006. They took a pause. They took a breather, kind of like what we're doing right now. And that pause did not allow the economy to avert the crisis, the Great Recession in 2007, 2008. Now, it took a little time to play out. I mean, they paused here in August 2006. Things really didn't start to fall apart until the end of 2007. So we've kind of just taken our pause here at the latest FOMC meeting. They stopped with the rate hikes. Will they stop at the next one? Well, maybe if the jobs numbers are weak, if we do get weak jobs numbers, they probably will continue the pause. Maybe we'll even see a plateau. But ultimately, I mean, what was the Fed forced to do when things started falling apart in 2007? Well, they were forced to slash rates to nearly zero. And this time around, excuse me, one thing you'll notice is that the hikes that the Fed has embarked on here in a much more highly leveraged system, by the way. So, this is a system which has a tremendously higher level of debt than the economy had back in 2006. I mean, back then, the US national debt was under $10 trillion. Today, it's over 33. But they have hiked rates from zero to five and a quarter. Before they were hiking from one to around five and a quarter. And that was enough to trigger a massive collapse in a system that had a lot less leverage. So, this time they've hiked rates more from trough to peak here. It's a bigger distance. Even if they pause, things are going to fall apart. It's like, Jamie Dimon was out warning about the interest rates hitting 7% the other day. And it's like, yes, 7% would be a huge problem, but even five and a quarter is a huge problem. We have got banks losing hundreds of billions of dollars with, the 10-year yield at 3.5%. What's it going to look like now that it's up at 4.8%? This system cannot withstand interest rates this high. We've got surging small business bankruptcies. We have got a savings rate at record lows. We have got credit card debt at a record high at the same time that the rates and the delinquencies are surging. We can't handle five and a quarter percent. Now, is inflation going to continue to run out of control? Absolutely, because the deficit spending ensures that. So, where are we headed from here? Well, it's not pretty, folks. I don't know what's going to break first. I mean, maybe one of these banks will fail. Maybe it'll be a regional bank, a small regional bank like those ones that Wells Fargo was downgrading. Maybe it'll be a big bank. Maybe it'll be one of these big banks with this enormous derivatives exposure. One of the things that when you look at this chart from Fidelity, you see bonds losing, a 10-year bond losing 9% every time the yield goes up 1%. Well, 30-year bonds, this is magnified even more so. Remember, the longer the duration of the bond, the more the bond loses value as interest rates rise. Well, think about the banks, think about the mortgages that they are sitting on. What's a 30-year mortgage rate right now? It's close to 8%, I think. And so, if a 10-year bond loses 9% of its value for every increase in the yield by 1%, how much does a 30-year debt instrument lose? It's even more. So, all of these mortgages that the banks are sitting on that they issued during the low interest rate period that have all these low yields, these mortgages are losing value just like the bonds are. So, interest rates are a huge problem for these banks and for this over-leveraged financial system. And another thing that banks did is a lot of them, somebody said, why would banks go in and buy these low yielding bonds? I got a comment the other day. Well, it's because they needed to generate yield. And one of the things that many of these banks did was they used leverage to do this. So it's like, well, bonds are only yielding 0.25% or 0.5%. Well, what am I going to do to generate yield? Well, I'll use a bunch of leverage. I'll go borrow a bunch of money and buy them. And that way I'll get more yield, because if I'm only getting 0.5%, I need to own a lot of these things to get any yield. Well, the problem is then when you have leverage introduced, that means your losses are magnified too. And so, eventually these banks are going to break. There's a reason that right now the Bank Term Funding Program, that's the emergency lending facility that the Fed instituted back in March, which allows these banks to take these bonds with all these unrealized losses and put them up as collateral for loans at face value. There's a reason that right now that is at a record high, and it's because the banks are continuing to come under stress. And I think we can expect that credit facility and the Fed's balance sheet in general to wind up holding a lot of this bad debt. But the problem is for the Fed that once they do that, the cat's out of the bag, and investors are going to realize that inflation is going to be the name of the game moving forward. So, they're going to need a pretty big crisis to give them the political cover to begin running the printing presses again. But I really think that's coming. And, I'll try to keep you up to date on this. It might not be tomorrow, it might not be this month, might not even be this year. When you look at the chart of the federal funds rate, I mean, the Fed started pausing in August of 2006. And again, it was over a year before we really saw the system collapse. But during that time period in 2006, 2007, there was all this talk of potential soft landings. The Fed's going to get everything under control. Well, this time around, folks, the problems are magnified. I mean, none of those problems that existed in 2008 were ever resolved. They were just papered over. So we have all of those problems, plus the fact that we have a much nastier geopolitical situation. Nobody's willing to buy our debt like they were back in 2008. There's a huge amount of debt, far more debt now. Back then, the credit card debt in the United States was like $300,000. Now it's over $1 trillion. Um, anyway, get ready, folks, because the pain isn't over. Don't buy the hype. You hear a lot of people talking about buying the dip in these stocks. Maybe, for me, maybe buying some miners or some energy companies. Maybe, but overall, like tech stocks, I mean, that stuff is all trading at these enormous valuations. Just look at the Schiller PE index for stocks. I mean, it's crazy. It's like at the same level now as it was back in 1929. So I do think we're being set up for more pain here in the stock market, in the bond market. The sell-off isn't done. How long will it take for this to play out? Nobody has a crystal ball. Could be weeks, could be months, could be a year, maybe. I don't give it much longer than that, though. I think 2024 is shaping up to be a very interesting year, if you want to call it that, not in a good way. And who knows, before we wrap up 2023, we're getting close here towards the end. We're in the final quarter of the year, and we're on the verge of a major collapse. So do what you can to get prepared, folks. Let me know what you're doing to get prepared down in the comments below, and just stay safe and happy stacking, everybody. I'll catch you next time. Smart Silver Stacker out.